All right, excellent. We've learned about the history of investment banking, about the difference between commercial and investment banks, about Chinese walls, and the four main areas of investment banking activity. We took an in-depth look at the world of capital markets. We've made great progress so far. Our next task is to learn more about mergers and acquisitions, a popular choice among people attracted by a career in investment banking. Mergers and acquisitions, as you already know, is a term that describes the consolidation of companies. The main idea is that 1 + 1 is equal to 3. The combination of two businesses is worth more than their separate, standalone values. Why? Why would these two companies be worth more if they are brought under the same roof? The answer is synergies. Company executives and investment bankers believe in a merger if they see a potential for synergies between the two companies. Usually, the two companies operate in the same industry. Let's consider an important transaction that happened recently. Microsoft bought LinkedIn for $26.2 billion. Why would a company like Microsoft want to buy LinkedIn? Microsoft is one of the largest IT companies in the world. It produces computer software, consumer electronics, and is active in a wide range of other businesses in informational technologies. LinkedIn operates the largest social networking service oriented towards professionals. It has access to many professionals and companies with profiles on its platform. This was a move with a wide-ranging impact in the tech world. Let's think of some reasons why Microsoft went through with this deal. Number 1 on the list must be synergies. For sure, some efficiency synergies are realized in every transaction of large companies. Certain fixed costs can be shared between the two companies. Accounting, administration, HR, top management, Salesforce, and IT support are areas where Microsoft can obtain efficiencies. Such efficiencies usually mean people being relocated or losing their jobs. This isn't pleasant, but that's how the game is played, right? Companies must be efficient if they want to stay in business and continue to offer great products. Another synergy that can be obtained is the more effective use of sales teams, who will be able to offer more products to their clients. When Microsoft sells Office software like Excel, PowerPoint, or Word, it can offer online education available on LinkedIn. So this is a synergy resulting from an expanded product portfolio offered to existing customers. In addition, many people who use Microsoft Outlook have all of their business emails collected in LinkedIn. So there are new ways Microsoft can integrate and extend this franchise by owning it. This is a product line extension. Both businesses will gain access to new distribution channels. Microsoft is uniquely positioned as the number 1 business software provider in the world. It's been working with business clients for decades. And fortunately enough, these are LinkedIn's main customers. It sells job postings and other premium services to business clients. Therefore, LinkedIn will benefit from Microsoft's distribution channels, and vice versa. Microsoft will benefit from LinkedIn's existing distribution channels. Another hot topic in M&A deals is the acquisition of key personnel and strategic know-how. Companies are very interested in acquiring great talent, and with Microsoft and LinkedIn, both companies employ world-class talent. By joining forces, these people can work together and create products that will succeed in the new generation of cloud-based services. Technology is a business where a handful of people can make a huge difference. Have you heard of defensive M&A? This is when companies want to make sure one of their competitors won't buy the target. Sometimes even the target can be an important competitor. Therefore, its acquisition will solve the problem for the acquiring firm. If Microsoft hadn't bought LinkedIn, it could have been acquired by one of the other firms in the industry, perhaps Google. And then Google would have access to LinkedIn's customer base, top talent, strategic know-how. It could have integrated Gmail and LinkedIn's email contacts, which would have endangered Outlook in a significant way. You see, There are hundreds, if not thousands, of possibilities. It's a chess game with endless combinations. That's why it is so interesting. Only time will tell if Microsoft's acquisition will succeed. They paid a fair price for a uniquely positioned platform with a solid network of users. In the meantime, we've done a good job providing an answer to the question, why acquire another company? M&A deals occur for several reasons, and everyone who wants to work in the sector must gain an idea of the rationale behind large mergers and acquisitions. Now that we understand the rationale behind M&A deals, we can answer another important question. At what point of a company's life cycle can we expect these deals? Let's look at the following graph. It depicts the various stages that a company goes through. The horizontal axis shows the development of time, and the vertical axis explains the revenue that the company is expected to generate at a given stage of its development. The 4 stages are development. These are the early days of the company, when it makes little to no money and is still a startup. Growth, an exciting period when the company breaks through and sells more of its products. Maturity, businesses become very profitable and competition increases significantly. Decline, the company loses market share because of a declining product portfolio or substitute products. Gradually, its profitability declines and it starts to burn cash. All right, so these are the 4 stages a company goes through. Let's look at these stages in the context of M&A. How likely is it that a company will buy other companies in its early startup days? No, it won't, right? It has no money to do that. Startup firms are often acquired for their innovative ideas or quality team. They are ideal for the so-called bolt-on acquisitions, being relatively cheap and full of upside. Growth firms are an attractive target for larger companies. The established players in an industry have specific departments with people who carefully study such growth firms. These companies aren't the typical buyer either. They have a lot of opportunities to grow organically and use their cash to invest in their own business. Mature firms are frequent buyers of startup and growth companies. Understandably, these companies are cash-rich and can afford to acquire external growth when they need it. At this stage of development, it is not infrequent to observe mergers of equals, too. The main purpose of these transactions is dealing with overcapacity. If there is too much competition within an industry, the merger of 2 competitors makes sense. Another type of transactions frequently observed at this stage are leveraged buyouts, which are very peculiar. Later in the course, we will focus on LBOs, and you will even learn how to build an LBO model in Excel. And finally, we have the declining stage. Companies in this stage of development aren't very attractive in terms of growth potential and profitability. This doesn't mean they don't have quality assets. Often, these companies are acquired for their name, brand, patents, know-how, historical relationships, or access to distribution channels. These are established businesses that have become obsolete with time and need a complete turnaround. Great! We describe the deal lifecycle. Stay tuned for our next lesson, where we will discuss the various M&A processes we can have. Let's look at the 3 ways in which an M&A transaction can be carried out. We have a private transaction, in which the target firm negotiates with 1 or 2 bidders. A full-scale auction representing a bidding contest among interested firms, and an M&A process in which the target firm is listed on the stock exchange. A private transaction is the easiest to organize and conclude. Given that only 1 or 2 parties are involved, communication can be fast, and timetables are kept relatively short. The main downfall is that the buyer won't feel threatened by the competition, understanding that the target firm has no other options. Well, that's not entirely true. Usually, the target has an option of deciding it doesn't want to go through with the sale. Sell-side bankers avoid this process and use it only when there is a single best owner of a business and there aren't other interested bidders who represent a credible threat. Auctions can involve tens of interested bidders. This is a standardized process with a few stages of elimination. The aim is to have at least 3 to 5 serious bidders who will submit final offers. The perception of competition increases the price bidders are willing to pay. Investment bankers prefer a few viable options, as this increases urgency and facilitates negotiations. The third situation we can have is the sale of a listed firm. This makes things more complicated from the point of disclosure and investor relations. The company's shares are traded on the stock exchange, and any leakage of information can be a serious issue. Bidders can choose whether to contact the firm's management or make a direct tender offer. If they have the approval of the company's management, we are talking about a friendly takeover, while a takeover bid that doesn't have management's approval is hostile. It is much easier to value public companies given that their shares are already priced on the market. What happens in practice is that buyers will offer a premium on top of the company's share price to convince shareholders to sell their shares. The mechanisms of buying the shares of public companies are rather complex due to the granularity of their ownership structure. In most legislations, if a bidder acquires a qualified majority of a company's shares, then he may squeeze out the remaining minority of shareholders by paying them an adequate compensation. So, these are the 3 types of M&A processes: private transactions, auctions, and acquisition of listed companies. Thanks for watching.